What's going on, guys? Um, so I'm going to do for this video a little bit of a recap of kind of what we went over last video, but I want to talk about another important subject, that being what's actually behind the market. How does the market move? Who moves the market? All right, so I'm going to start out essentially by talking about the market makers, the liquidity providers, and supply and demand. So, like everything else in the world with a price tag on it, the changes in price depend on supply and demand. So the foreign exchange market is made up of a vast sea of traders who want to buy and sell currency pairs. I would imagine that if you're watching this video, you'd have some degree of understanding of supply and demand. Um, so like in any open market, we find that when there are more sellers than buyers, the price goes down. Conversely, when there are more buyers than sellers, the price goes up, right? Simple supply and demand, I'm sure you're aware of that. So, an important thing to note, however, is that the foreign exchange market or the stock market or any really market, um, it's not a direct transaction market. You do not buy or sell with another trader on the other side of the table. Instead of doing that, you place your trades through a middleman called a market maker or liquidity provider, as I talked about in the last video. And I really want you guys to take notes on everything I'm talking about and even what I've said so far, because this understanding is like critical behind your own analysis. You have to understand what actually moves the market and how the market moves and how it works, if you want to do proper technical analysis. Um, so what's a market maker? A market maker is a person or firm willing to essentially accept the risk of holding a country's currency and stands ready to buy and sell that currency from and to other traders or investors. And why are they important? They're important because they provide a significant degree of liquidity for the market. And a logical question to ask is, if I decide to sell my position, how do I know if there's someone in the market willing to buy them? And that answer is essentially, you can generally buy or sell currency pairs at any time you want because the market makers are standing by ready to buy and sell at any given time. In fact, it's their job to maintain liquidity in the market. So suppose you bought Euro USD on 100 lots and you're in some profit and you want to sell that position. So how do you know there will be any buyers, right? Someone going to buy it, buy it back for you. You're selling it back, your position. Well, one of the features of the markets is that there's always a balance of buyers on one side and sellers on the other. And so let's look at really how the market makers maintain this balance. If you want to buy Euro USD, you can see that the market maker is asking, well, not right now, but just for example purposes, let's just say the market maker is asking 1.1092 for a unit of Euro USD. This is called the ask price, which is the price the market maker is willing to sell it to you for. And if you want to sell Euro USD, you can see that the market maker is willing to buy it for, let's say, 1.1089. This is the bid price. This is the difference between the ask and the bid price is what's called the spread. And it's how the market maker earns his living, quite frankly. But like a pair like Euro USD, when there's a lot of units being bought and sold, the spread's usually quite small. So you'll probably notice on your broker that compared to other pairs or crosses, that Euro USD has smaller spreads. It's because everyone trades Euro USD, so the spread is tighter. But it's still how they maintain the balance and they make their living. So the market makers will always buy your units of currency pairs, and they will always have units to sell you. Their goal is volume, and by adjusting their prices, they can achieve volume whether the price is shooting up or falling like a rock. let's see. In terms of balance, is what I just talked about. The market makers keep the balance between buying and selling. If there are too many buyers, they take the price up. And they're going to keep pushing it up until it reaches a point where people are willing to part with their positions. If there are too many sellers, they'll take it right down until some people start saying, "Gee, that's cheap. Maybe it's maybe it's worth the risk at this price." This is why proper technical analysis is so important, so you can easily decipher this story that's being printed on your charts. Let's see what else I have. Finally, let's establish one critical principle. The market makers are not concerned with how high or how low the price goes, right? They don't care. They don't care if it's shooting up fast or dying. Their only concern is to keep a balance between buyers and sellers, because they need to maintain the spread between the ask and the bid prices. So quite frankly, the little overbought and oversold RSI indicators are garbage. There really is no such thing as overbought and oversold. At the end of the day, it comes down to supply and demand and the balance that these market makers are trying to maintain in the market. Now, we kind of went over the smart money concepts, a brief introduction in the last video, and I want to kind of touch up on refresh those principles, but also go over what's called as imbalance, and it's another tool we use or method we use to identify trade setups in the market, and we kind of use that in conjunction with what we talked about in the last video in terms of areas of liquidity. So on EURUSD, we'll get into the charts here. You can see here that price slowed down in momentum, and we made a break of structure here, okay? And this is the 45-minute time frame, by the way. We came down once and then twice, and we didn't take out this initial low, this initial pullback after this impulsive move. Right, so in what we talked about in the last video, we have essentially relatively equal lows, which means liquidity, money. All right, so we know as smart money traders not to buy here. We're not buying at equal lows because we know we want them to be taken out. All right, so we waited, and what did we have here? We had these equal lows being purged, with the pocket of money taken. So in terms of preparing for this setup, you can see equal lows here. Now we're looking left to find what was our last sell to buy candle that took out liquidity. You can see this liquidity in here was taken out with this move, and this is our last sell before the big up move, before the impulsive move. So there you go. That's the entry right there that we took last week. All right, and we had 2.5 pips of drawdown. So, okay, now that we're in that trade, where do we want to target? All right, so obviously you want to start on the higher time frames, but what we identified on the 4-hour time frame was that this was our last little pullback, right? So there's liquidity above here, but not only that, is there is an imbalance in the market. And if you had taken notes on what I talked about in the beginning of this video, you'll understand what I'm saying here. So an imbalance in the market, we had a very strong impulsive move, all right, in one direction. And you can see from the difference between this wick and this wick, there was no buying offered in the market. It was only selling pressure between this wick and this wick. Fill it in with some color. So there was only selling pressure offered, no buying offered, as the wicks do not touch. Okay? So in terms of a target, right, because we entered here, we have identified now an area of imbalance that the market makers need to fulfill, right? They need balance in the market, okay? And so we'll come back to that in just a minute. Now that we got our first entry, what do we understand? That it required this volume, this candle, to mitigate out of our initial position here, to mitigate out, to then release that liquidity to allow price to rise. So we have an entry down here, and now we understand that this candle took out this liquidity. So there's your secondary entry. You're already at break even on your initial position, which is great, and now you can add an additional position as you're risk free. So boom, right at the open, price right at the open of London session comes down 3:30 a.m. mitigates out of this sell to buy that took out liquidity, and there you have two positions and riding this thing to fulfill that imbalance. Not only fulfill that imbalance on the 4-hour time frame, but take out this liquidity here. Okay, so hopefully in the next few pairs you can start to, if you haven't already, grasp this concept of imbalance. It's really when there's no, if you have an impulsive move, say to the downside, that there's no buying offered in a specific region of price. So I'm going to have my buddy Nathan Jester go over some more pairs, some more trades that we took last week. He's a friend of mine who trades with me, and we're actually in the process of starting a signal service that signals that are paired with analysis, and we'll have more details on that later. Probably in the next video we'll talk more about it, but I'm going to hand it over to him, and he's going to go over a few more trades that we took last week.
All right, thank you, Aiden. And I think you did a great job touching on the important key aspects of really what the Forex market is and how you really should go about trading. What are the market makers? How do they do their business? How do they take people's money? And how do they make people lose? It's really important to understand these key concepts, because if you don't understand them and you don't know how they work, you will never be able to beat them. Retail traders, what they would do, I'm just going to go over this really quickly. They would take their little handy-dandy trend line and do something like this, right? And they're looking for bounces off the trend line, 1 touch, 2 touches here. Oh, it comes down into this trend line again, 3 touches. Oh, people buy it because they think, oh, trend lines work. No, they don't, because they're going to entice you to buy right here. Because look, 1 touch, 2 touch, 3 touch, you're going to buy it off that bullish engulfing candle. Guess what happens? Bing, falls all the way back down. See, this is why retail trading does not work. It does not work. So everything that you have ever learned from anyone else, retail-wise, trend lines, Fibonacci's, they work, but they're not very important. All that stuff, it doesn't matter. It really doesn't. This is how the market works. This is how you really can make a lot of money doing it. So, let me go over USD really quickly. I know he already touched upon it, but I want to go over the imbalance fill that he went over. So as you can see, we mitigated out of this position here, a 45-minute time frame, like he said, and we took liquidity, blah, blah, blah. Great. Now, where's your target? Okay, so we have 2 positions, one right here, one right here. I actually took this trade, and I took it out right at the top of that wick. How did I know that it was going to stop right there and just die? Well, look. Let's go to the 4-hour time frame. Okay, so as we can see, and this is why you have to look left. Not just look left here, but look left over here. Price has already been accounted for in this region of pricing, okay? So this is the reason why it fell from this area. There is no other imbalance fill that needs to be filled, no other mitigation play that needs to happen. Everything has been accounted for, which is the reason why price stopped right here, okay? And I'm going to zoom in here, and as you can see, between this wick and this wick, we have imbalance. Obviously, price needs to come back up there and fill that, which it did to the exact T. And then we took a sell position from here. We got out of our buys, took a sell, and now we're riding it down. really break this low here and take this liquidity, you really have to look at structure as well. Structure is important. And what I mean by structure is basically your lower lows, your lower highs, your lower lows, your lower highs, in conjunction with all other time frames here. Starting from the monthly, doing top-down analysis, monthly, weekly, daily. All of these key concepts that we have been going over applies to all time frames. Even the 1 minute, to be quite frank. Okay? So I hear a lot of people answering the question of imbalance. I would ask them, what is inefficiency? And they would say, oh, it's just the distance between this wick and this wick. Oh, price is going to come back up there and fill it. Congratulations, you're retarded. Okay? That's not how it works. I mean, yes, that's an answer, but that's not the real answer. The real answer is that price is basically a skip in price. So price went down so fast, never had the chance to come back up there and claim those sell orders. They were selling really, really fast, did not have enough buying pressure to come back in there and account for those sells. Which is why we have to come back up there and refill that imbalance. Okay, so now I'm going to be going over a couple more pairs. AUD, USD. Okay? So I'm not going to go over why I'm going to go over why we took this trade, but I'm not going to go over structure. I think that is really self-explanatory. That is something that you can look at going through all these time frames and why we're looking to buy into here and then sell. But just to give you a little bit of an understanding, okay, I'll just draw up this for you right here. So we have an area of supply, okay? You can go back and go through all these time frames and look at the structure, but I'm not going to do that. It would take way too much time. This is structure right here, okay? You have your so-called resistance, your support. We're looking at price to come back into that area and create a resistance via supply, okay? Because a lot of orders were being taken from this area. And what I mean by that is that when we came back into this level of structure, okay, a lot of people thought, okay, this pricing is good enough for me to buy, right? Okay, so people started to buy, then it fell through the structure. Now we came back up into this region and people wanted to sell off. So this price, this area between really 0.694 and 0.693 is a supply region. People react off this price. So now going down to the 1 hour time frame and why we took this trade long. Again, you don't see any trend lines on my screen whatsoever. Okay, price was accumulating in this range. Okay, and what we can see is that we have relatively equal lows. Okay, so what do we know about that? That needs to be taken out. So does this, relatively equal highs, which it did, but we're not buying up into here. We're buying right here. Okay, so this eventually I do expect to take out because guess what happens? People start buying, they start buying, they start buying, they put their stop losses down here. What do the market makers do? Their job is to take people's money. If people are buying in here, there's so much money down here, so many stop losses. Market makers are going to come down, take that liquidity, take that money, hit people's stops, and then they go the opposite way. And people wonder, oh, why did I get stopped out by maybe 2, 3, 4, 5 pips? Well, that's all they need to do. They push price just below this level, and they could reverse and go long, or they could continue going short. It's just all about taking retail traders' money. So why did we come into this price here and then bounce? Okay, so as you can see, we broke structure. Okay, we created a low. Then we created a higher high from this high here. Okay, now we're coming down to create a higher low. Okay, so basically lower low, higher high, higher low. Okay, from this break of structure, we're looking for some sort of pullback, some sort of correction to go long again. Notice there is an area right in here of imbalance. Price went so fast, we need to come back up and fulfill that. Okay, so we know that price needs to come back up in here, and structure says it itself. Okay, and I went over that a few minutes ago, that this is a key supply area. So if people are shorting in here, well, we need to reach up into this level. We're looking for a pullback and then to come back up into this price point and then fall. Okay, so let's go over the technicals as to why we entered this trade. So you have to pinpoint your area of interest. Basically pinpointing your sponsor candle or your last sell to buy move, okay? Price shot up so fast here that there are some selling orders in here by the market makers, okay? They have to mitigate out of these, and mitigate basically means to make less severe of their selling orders. They need to come down, break even on these sells. They're already in these buys. They need to break even on these sells and then finally continue with their buys. And that's how they make money and mitigate out of positions. So price has already been accounted for over here, okay? This wick here, between this wick and this wick, there is no imbalance that needs to be filled. Everything has been accounted for. This is our last sell to buy. What do? We mark it off the open because that's where our orders are accumulated here, okay? Market makers place their orders here, which is why price pushed down, okay? So you could have placed an order here, and algorithms state that 50% is also viable for this as well. And then there's also a 30-minute sponsor. This is why it's crucial to go down the time frames. So if I go down to the 45-minute, I don't see much. I mean, I see this last sell to buy here. That doesn't really look good. Going down to the 30-minute, let's check this out. Our last sell before the up move. This went so fast, our last sell before the up move, we need to mitigate out of this position, okay? So forget your trend lines, forget your RSI, forget anything else that you were taught. This is how you trade, and this is how you will make money if you master these key concepts. Our last sell to buy, we place our order right there. Guess what happens? Hits it to the T. Zero drawdown. This is why we get 2, 3, 4, 5 pip stop losses. And the risk to reward on this is insane. It's ginormous. You know, screw the people who have 30, 40, 50 pip stop losses because they don't know how to really trade, okay? That lowers your risk to reward, and over time, you have to be even more consistent with your trades in order to profit. Here, if I have this every single time and I have a 5 pip stop loss, the risk to reward could be like 1 to 30, 1 to 40 even. That means that I can lose 39 trades in a row and win one, and I'm break even. Just think about that for a minute. The risk to reward is crucial. Okay, so why do we stop here? Why did we take profit here? Okay, we entered here and we sprung. We mitigated out. Market makers are ready to go. Bing, out of their sells, into their buys. Why do we stop here? Okay, now you got to zoom out. Okay, so obviously we have pinpointed an area of supply, right? Price stopped here, shot up, shot down, price stopped here. So price has been reacting off this area. Okay, I'm not going to go into structure as to why it's going to stop here instead of creating another higher high up here. That's just something you have to look for in higher time frames to really understand how, you know, higher highs, higher lows work. That's really self-explanatory. But this is very detailed. So I'm going to go to the daily time frame here, and I'm going to show you. Actually, I'll show you this. Why did price stop here? Okay, we have liquidity, liquidity, liquidity. Price last buy before the sell-off, right? And we're in a downtrend overall. Okay, lower low, lower high, lower low, lower high. We're looking to make another lower low. Okay, last buy before the up move. There's so many buy orders, they have to come back and mitigate. Guess what they did? They mitigated and dropped. Okay, so that's why we're going short. Now, why did we set our take profit here? You could have set it. This would have been your first point right there, because that would have been your imbalance fill. Okay, I'm gonna draw the zone for the imbalance right in there. Okay. Because price initially came here, right? We left this area of imbalance between here and here. We need to come back up and fill that and retest this supply zone. Guess what we did? Bing, got out here. That's what? That's within like 6, 7 pips. I mean, this is why we are very accurate We understand these key concepts. We understand how the banks trade, how the market makers work, how they take your money, and how they screw retail traders. We're taking advantage of that and then profiting from it. Okay, so that's AUD USD. I am looking for some sort of retracement up into this region. I'm not going to go over, setups for the current week. We're going to do that later on in our videos, but I'm looking for price to drop. Next, what I'm going to go over is NZD USD. So you understand all these key concepts, okay? So I'm not gonna really hone in on them. I'm just gonna really tell you why we took them, okay? So obviously we're in a downtrend, as you can see. Price came up with this candle here, took out this liquidity, snatched that. Now we want to drop, right? We had some follow through here. Now we zoom in, okay? So we took this liquidity, knowing we're in a downtrend, we want to make another lower low. We took this liquidity here at this last push up before the sell-off. So mark off your open, because that is where the market makers or liquidity providers have their orders for buys to take out the liquidity, to take out this money, to then sell off. They need to come back and break even on these buys. That's why we have to come back up into this price point. Guess what happens? Hits it to the T. You have a 1 pip stop loss, 2 pip stop loss. Account for the spread as well. So if the spread is 2 pips, place your stop loss 3 or 4 pips, just so you can account for that spread. And then we just died. This stuff is not hard. It takes a lot of practice, a lot of discipline, looking for the same setup every single time. Something may look good, but this is why you have to have your rules, your confluences, your checklist, everything that needs to be checked off. And guess what? You will be profitable, you will be consistent, and you will be rich if you follow these rules and understand exactly why they do this, when they do this. And I guess we can go over that in another video, times of the day that they do this in. Okay, so where do we take profit? Well, knowing that we want to make another lower low, we are currently in this trade, looking at the daily time frame. This is why at the end of the week, or even at the end of the day, look at your daily time frame. Look at how big this move is. This engulfed really all of this price. I know we have a lot of price in here, but it engulfed the previous day, okay? Now, that indicates follow through, okay, from this move down. So we're looking for price to continue lower. I'm not going to give you a re-entry. That's something you'll have to subscribe to our service for our trades. And trust me, it will be in your best interest to do so, for we have the skill, the knowledge, the consistency to make you money. All right, last one. Or actually, let me do two more. I'm going to go USD CAD and GBP USD. Okay. USD CAD. We're looking for something this week. I'm actually not going to go through this, but I will show you just how precise this strategy can be, okay? This is what I want to show you right in here. This happened a few months ago, back in 2019, okay? Obviously, we have so much liquidity built up here, money. People are selling. There's so many stop losses up in here. Guess what the market makers do? They push price up, stop people out, shoot back down, and continue in the right direction. On all time frames, monthly, weekly, daily, we are in a downtrend. So it is to say that structure is to the downside, okay? So now, what did we do? We have higher highs and higher lows in here. Higher low, higher high. We broke structure, okay? Now we need to come back up and retest of some sort before making another move down. But guess what? Where is our area of interest? We have to zoom into this candle because price, obviously there was some buying and there was some selling. So we have some buy to sells. Moving down to the 4-hour time frame, this is what we have. Okay. We have our last buy to sell move. This candle right here took out all this liquidity. Market makers need to come back up, mitigate out of their positions before continuing in the direction of trend. So what do? We mark off the open, which is where they have their orders, okay? And then we have all this price in here, right? What are the market makers trying to do? They're trying to get you to sell because they know they have to come back up here and mitigate. It's so easy, okay? Yes, we're slowing down in momentum, but looking at the overall picture is going to be very important, okay? So they have so many sell orders in here. People are selling. They have this last push down, okay? Their last push down, people are like, I don't want to miss this trade. I want to get in. They sell. Guess what happens? Rallies to the upside, mitigates out of this position to what? The T. See, this is why we get the biggest risk reward. And this is why we were able to put lots on lots on lots. Lots as in the lot size you use. We put 1, 2, 5, 10 lots on this because we're risking the same percentage, but because we have such a tiny stop loss, we're able to do that, which is why we make so much money. So we mitigated out, we fell, okay? And now we're continuing with the trend. Last one, I'm going to go over GBP USD. Just bear with me 1 second. Alrighty. What do we have here? Okay, so we were looking at price last week right in here, okay? Obviously, we can see we're making lower lows, lower highs, lower lows, lower highs, lower low, okay? Lower high right in here. Relatively equal lows, okay? Then we broke structure. We created a higher high. What do we have to do? We have to come back and make a lower or a higher low to make another higher high, okay? Ultimately, we're not targeting another higher high way up here, okay, because we are in a downtrend. So this is, I'll tell you why we targeted this region before selling off. But this would be your buy, your short-term buy for your long-term sell, okay? So going down to the hour time frame, what do we see? We have our last sell before the buy, right? Okay, so a lot of people would place their order here, okay? And this is all dependent on how you trade, how much you're willing to risk, and via stop loss, okay? So looking at this candle, this is a 25 pip candle, right? I don't want to place a trade right here and put my stop loss just below the low of this candle because that lowers my risk to reward. What do? If such a strong candle, such a big candle happens before the up move here, we can put it at the 50%. Algorithms say that 50% is viable for this as well. It doesn't always come down to the 50%. I would not have been surprised if it came to the open and then went long, but since there's so much selling volume in here, so much selling pressure, there's so many orders in here, good chance it would come to the 50%, which we did. So we created a higher high. From this high, we broke structure. We pulled back 50%, right? So I can just do this really quickly. Something like this. Targeting somewhere up there. Oh, whoops. Targeting somewhere up there. I'll go over that in a minute. And then your stop loss would be right below the low. Not below the wick. You don't have to do that. Right below the body closure. And that's a lot better. That's like 11 pips versus 25, 30 pips. All right. So now we are in this buy. We're riding it up. Where do we take profit? This is another key. Okay, take note. You have to have a set entry, stop loss, and take profit in before you even take the trade. You have to know where you're targeting. You have to know where your stop loss is. Or else, guess what? Just like any other retail trader, you're gambling. You don't know what you're doing. You're placing a buy. Where are you going to buy it to? Where are you going to take profit? Where are you going to sell it? You have to know these things. All right. So, obviously, we have liquidity up here. Let me go to a higher time frame. All right. all along here, price has been accounted for, right? You see this wick in this wick right here, we rebalance ourselves, mitigated out. All of the imbalance has been filled. But guess what? What has not been filled? Right here. Our targets aren't always imbalance fills. Oftentimes they are, but they not always. You know, it could be a sponsor candle, right? A sponsor candle is in our last buy to sell move. This isn't a sponsor candle to me. I mean, yes, it's our last buy to sell. Maybe we can go over what a real sponsor candle is in another video. But we want to fill in this imbalance here, okay? So we target the imbalance fill, which is right here, right at that wick. Okay, I can get rid of this box. And guess what we have? We hit it not to the T, but it's very close, okay? How often do you get, a target this correct? Like, how often when you place your target, does it hit the target and then actually go in the opposite direction? Okay, that's what we're trying to do. We're not saying, oh, we're just going to target here, and if it goes up, well, whatever, we're out of the trade, we made money. Well, yeah, great, you made money, but we want to understand why it started to go this way, why it started to sell off. That's why we have targets. Okay, so now what we're looking for is to make another lower low. What I want you to do, okay, is I want you to look at this where price is. Okay, where price is right here. It is the 20th of January, okay? It is about 7:47 in the evening. Go to this time right here, January 20th, and I want you to mark this up because there is another sell position that we are looking for, okay? Let me give you a hint. Liquidity was taken here, okay? There is some buying and quick selling. Look for some sponsor candles, okay? Look for imbalance fills. Place your entry and your stop loss and your take profit, but know exactly where those are, okay? So try it out for yourself, and let us know what you come up with. So that's basically the outline of what we're trying to really say. All these key concepts are very important. Practice them, practice them, practice them. Make notes. And be sure to follow us on Instagram. We have an Instagram channel, ArielFX __. So it's ARIEL__FX. Follow us on Instagram. We have our profits, our actual profits, our analysis, pretty much everything that you need. We're not going to give signals on that. That is for our service. And we are very transparent with what we say. We took a CAD JAPI sell last week. Okay, CAD JAPI, CAD JPY. We go down to the hour. I'm not going to go over this, but we took it right here because we saw this low here and we saw this low broke here, and we're looking for our last buy to sell. We broke structure. We placed our order here, and placed a take profit right above the body, and guess what? It hit it. So yeah, you know what? We lost on this trade. A lot of signal services and people who break down forex pairs, they don't go over their losses because they don't want to sound like they're bad. Everyone has losses. It's part of the game, but we win more than we lose, and we have a huge risk to reward doing so. So that is all we have for you. Let us know in the comment section what you'd like us to go over next time, what you like, anything specific. It could be a pair, it could be a concept that we need to go in further depth. Let us know. We want your feedback. Be sure to like, subscribe, comment, and give us a follow on Instagram. We hope you enjoyed this video. Stay tuned for our next one.